Okay, greetings guys. um Sorry for the other video. Like I told you guys, the other video I did, my microphone was not on, so there was no sound on it. So we are going to continue it by doing another one today. So let's head down to TradingView immediately. So welcome. So whatever I'm going to be teaching today is something that we have already done. These things that I've already taught you guys already, but I'm actually making this video in case of those of you that want to go back to the videos and do what, restudy again, in case maybe you're actually lost in the market, or maybe you're actually a newbie in this group that want to actually know more about our strategy and stuff. You understand? So I will start now by going deep into the market. So what our strategy is that we talked about, our strategy is basically what is basically SMC. That's our strategy. And this our SMC means what? It means smart. It means smart money concept. It means smart money concept. This is what our strategy means, SMC, which means smart money concept. So for those of you that are actually confusing yourself about what's the meaning of SMC and SLP, because some people are actually comparing it, that SMC is different from what SLP. You understand? That SLP means structure, liquidity, and POI. But one thing most people don't understand is all these are the same thing. What makes up SMC? Yeah. What makes up SMC is the structure, liquidity, and POI. That's what built the strategy called SMC. You understand me? That is what built the strategy called SMC. Now, if you are talking about like the properties of SMC, that is where you are going to talk about what? When you're talking about the properties of SMC, that is when we'll go down to talking about what? Go down to talking about the market. We're going to talk about the market structure. That's where we'll talk about the market structure. Then we'll talk about what? The liquidity. And then we'll talk about what? The POI. The POI, which means what? Points. Sorry. Which means what? Points of interest. Which means point of interest. So this is what our strategy comprises of. You understand? This is exactly what our strategy comprises of. Our strategy comprises of what? The market structure, the liquidity, and the POI. You understand? Now, explaining detailedly before we actually dive into the main things that makes our strategy works, we are going to explain each and every one of these: market structure, liquidity, and POI. You understand? When you get to know what market structure means, liquidity is, and POI, that's when we actually get to know how the functionality of our SMC is. You understand? And how it actually helps us get trade or win trades in the market. You understand me? So let's dive down to the first one. Here we have what? We have the market structure. So for those of you that are actually having your pen, because I will not be writing on my screen the definition of what a market structure is, so I will just be reading out the definition of most of these things. So since it's actually a video, you can actually back forward it and actually listen to the definition again. You understand? Now, what is market structure? In forex trade, the market structure refers to the way price move on a chart based on trends and price key levels. You understand? This market structure now help traders to understand the directional bias of a market. When I mean a directional bias, like a directional trend of a market, and it's also help you to identify what potential opportunities for you to take your trades from. You understand? That is the definition of what a market structure is. In a layman understanding, you all sorry, you already know what a structure is. A structure is like a build up of something. You understand? Like if that sorry guys, if you're talking about the structure of a building, what are you referring to? You are referring to how that building has been constructed, everything. You understand? The construction of a building and everything that has to do with that building is what we refer to as what? The structure. So it's actually same thing when it comes to the terms of forex market. You understand? So that is that for market structure, but that's not all, because we have more properties of things that have to do with the market structure. Now, when we talk about the key concepts, sorry guys, when we talk about the key concepts of market structure, we talk about the key. Let me write this one down. Talk about the key concepts of market, key concept of market structure. When we talk about the key concept of market structure, that's where we have we have what? We have the first one. The one of the key concept of market structure is trend. We have the trend. We have the trend. Yeah. We have the trend. The second one, we have the swing highs. Swing highs. Swing highs and lows. Let me use this and swing highs and lows. Yes, we have swing highs and lows. We have break of structure. We have break. We have break of structure. We have break of structure. We have break of structure. Break of structure, which sometimes is abbreviated as what? BMS or BOS. You understand? BOS. Why is this thing always coming out? BOS. Yes. That is that. And we still have what? Okay, let's just leave it at that. Let me just add the other one. We have support and resistance in the market too. Have support and what? Support and resistance. We have support and resistance. You understand? I think we'll stop at that one. We'll just stop at that one. So these are the key concept of what? Of market structure. The trend, the swing highs and lows, the break of market structure, which is the BMS or the BOS, and we have the support and resistance. Now I am going to be explaining this detailedly. You understand? I'm going to be explaining this detailedly so you guys are going to understand, because I don't want somebody to come back and be asking me questions about all of this. This is why I'm making this video, and I'm actually making it like a beginner video so you can actually understand everything, so that whenever I'm actually holding like a live class, I'm just going to be deliberating on other things, like additional things that you guys are going to learn. So when we are talking about the trend, when we are talking about the trend, we are talking about when we are talking about the trend, which is the first one. When we are talking about the trend, we are talking about what? We are talking about what? Under trend, if you are let's put it trend direction. That's the full word for it. trend direction. When we are talking about trend direction, what are we talking about? The directions where the trend of the market, the trends that we actually have in the market, the direction of where the market actually moves to. And we have three of them. We have the bullish, it is called the bullish or uptrend. It's called the bullish or uptrend. It's called the bullish or uptrend. Then we have what? We have the bearish. Sorry. We have the bearish. We have the bearish. We have the bearish or downtrend. Have the bearish or downtrend, and we have the third one, which is what? The ranging market. The ranging. It is called the ranging or consolidation. It's called the ranging or consolidation. So this is what the trend of the market is basically about. And all of you actually know what the trend. I'm coming. Let me shift this accordingly. Yes. Now, when we talk about the trend, we are talking about the direction of where the market actually moves to. So we have basically three of them. We have the bullish, which is actually what? The uptrend, which simply signifies when the market is actually going up. That is what we mean by what? Bullish, when it actually signifies that the market is actually going up. And the bearish, which means the market is actually going down. You understand? When the market is basically going down, that is what we mean by what? The bearish or downward trend. You understand? Now we talk about the ranging. The ranging is where the market is actually moving at. We talk about the market moving within a particular zone. You understand me? We talk about when the market is moving within a particular zone. You understand me? That is what we mean by the market is ranging. Is moving within a particular region. You understand? That is what we mean. Now, practical example of what an upward trend is, which is the bullish. A bullish consists of what? Higher highs, higher lows, higher highs, higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows, higher high. You get me? This is basically how an upward trend is. It moves in a zigzag form like this, but it's actually moving towards what? An upward direction. And whenever the market is actually bullish, it creates what we call what? Higher highs and higher lows. Now, this particular point, the up part of this bullish market is called what? The higher high. The lower part of it is called what? The lower low. The up part here is called what? The higher high. The down part of it is called what? The lower low. You understand? That is what they say. An upward trend of the market consists of what? Higher highs and higher lows. In some cases, you will see on the chart, you will see people write you will see people write something like this. Sorry, you will see on some professional traders charts, you are going to see that on this up part here, you see they will write HH. On this down part, they will write HL. That HH means what? Higher highs. Then the down part here, which is HL, means what? Higher lows. You understand? That is that for the what? For the bullish trend, right? Let's take this off. Now, talking about the bearish trend, which is the downward trend, we have what? The market is actually moving like this, creating series of what? Lower lows and what? Lower high, lower low, 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 lower high, lower low. Now you understand. If the market is moving in a downward direction, which is the downward trend, this is simply how the market actually moves. You understand me? This is how the market actually moves, right? Now, if you look at this carefully, you see on the bullish trend, I tell you guys, like the bullish trend, which is the upward trend, I told you guys that the market moves in what? In higher highs and in higher lows. Now on the downward trend, the market moves in what? Lower lows and in lower highs. The down part of it here is what we call what? The lower low. The up part here is what we call what? The higher highs. You understand? The down part here, lower low. The up part here, lower high. You understand? So that is how it is basically. You understand? So that is that for the downward trend. If you don't understand, you can always come back to the video and watch and know what it is all about. Now when we are talking about the ranging market, we said ranging, you guys understand what the meaning of range is? Within a particular zone. That is when you see the market condition will be like this. The market will create what? Now listen to me carefully. When the market is actually ranging, the market creates what? Higher highs, then lower lows. Higher highs, lower low. Higher highs, lower low. Higher highs, lower low. Higher highs, lower low. You understand? When the market is ranging, now you can see that this market is moving within a particular zone. Can you see? It's moving within a particular zone. The market is not bullish, it is not bearish. That is, market is not going up, it's not going down. It is just moving within a particular region. So when the market is moving within a particular region like this, it is referred to as what? As a ranging market. You understand me? It is referred to as what? A ranging market. You can see that the market is not going up, it is not coming down. It is just moving, it is going up and down, but it's going within a particular range. So the up part of this ranging market is called what? The higher highs. And the down part of it is called what? The lower lows. You understand? So that is it for the ranging market. You understand? So let me go to the chart and look for examples of this thing I show you. Now if you look at this market, if you look at this chart now, this is a live trade on gold. This is a live trade on gold. Maybe before I post this video, the trade will be late for you guys to take it already, but this is a live trade that I'm to take. You understand? Now if you look at this market, basically now you see that the market is actually on the upward trend. You understand? For those of you that can actually see very well, the market is actually on the upward trend, because you can see series of what? Higher highs and higher lows. You can see it. This higher high here, higher low. You can see a higher high, a higher low. You understand? Down here again. You understand? Okay, that's a mistake for me. I'm supposed to stop it here. A higher high here, a higher low, a higher high here, a higher low, a higher high here, a higher low, a higher high. That is basically how the market actually moves. You understand? But if it's on the real chart, this is what the condition of the market always is. But this is actually a higher time frame, so it's gonna be somehow for you guys to see. But this is basically how it is. You understand? That is basically how it is. Sorry, let me screenshot something and send to somebody. um Yeah, I'm back. So that is what it is. That is for the bullish trend when the market is actually moving up. You can see directly that the market is actually moving. That's why you see this line that I actually drew below here. You can see that the line is actually straight, but it's actually going up. Now let's find now. Now this is an example of what? A downward trend. Look at it here. Look at it. The market creates what? This a lower low, a lower high here, a lower low again, a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, a lower high here, a lower low, a lower high, a lower low, a lower high here, a lower low, a lower high, a lower low. You understand? So that is what the market actually does when it's moving downward trend. You can see basically that the market is moving down, because if we are going to draw our arrow from here like this, for instance, we can see that the market is moving downward. Can you see this? This is downward, right? Yeah. So I don't know where we are actually going to get a ranging market right now to give you an example of it, but maybe when time permitting another class, I'm going to do that for you guys. Let's just continue with this and let's see how we are going to end this vid very quick. Now we are done with the trend, right? We are done with the trend, so that is all for the trend. So let me just take this off, let me delete that off. So we are done for the trend. Yeah, now talking about swing highs and lows, I've already taught you guys that when I was explaining what the higher highs and the higher lows for the upward trend and the lower low and the lower high for the downward trend. You understand? I already explained that for you guys already. No need to explain that again. You understand? No need to explain that again for you guys. So this other one here, break of market structure. Now this is what a break of market structure. What it means by break of market structure is when price actually move past the previous high or the previous low that was created. That is what we mean by what? Break of market structure. You understand? That is what a market structure, break of market structure means. And this break of market structure now actually gives you a signal telling you that what? The market is willing to continue going towards that particular direction that the market has been going. You understand? Towards that particular direction that the market has been going, right? That is what a break of market structure actually does. Now, a break of market, we have a break of market structure. There are actually two types. We have the one for the bullish trend and the one for the bearish trend. Now, let's dive into it straight up. Now, when you know that when the market is bullish, it creates what? Series of what? Higher highs, higher lows, higher highs, higher lows, higher high. Now, this is what the market structure is. Now, this is a higher high, right? And this is a higher low. This is another higher high, this is another higher low. Now, do you know that when the market moved from down here, created this higher high, created this higher low here, now the market move past this previous higher high that was created here. You understand? Now this previous higher high that was created here, this is where a break of market structure is. You get? This is where the break of market structure is, when the market actually break the previous higher high that was created. That is what a break of market structure is. The market has actually broken that higher high that was actually created here previously. That is what a higher high is. That's what a break of market structure is. You understand? And mind you, this one is actually what? For the bullish trend. Now, if you look at this one now, the market went up here, created another higher high, created a higher low, right? The market still went up again, broke this higher high that was here, the previous one that was created again. Now, this is what we mean by what? A break of market structure. You understand? That is basically what it is, right? Now, let's go to the other one. Let me not delete this one. Let me give you the example of the other one so you can physically see the difference. This one is for the bullish trend. This one is for the bullish trend. Now, let me go with the one for the bearish trend. When you have the market create this lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. You understand? Now, if you look at this now, when the market come down, creates a lower low, goes up to create what? A lower high. And the market now come down to break this lower low that was previously created to go down. Now, this is what a break of market structure on a downward trend is. You understand? This is what a break of market structure is. When the market, that is on the downward trend, when the market move past the lower low that was previously created, it's called what? A break of market structure on the downward trend. Now you can see that the market created a lower low, a lower high, came down to break this lower low here, formed another what? Another lower low here, created another lower high, came down again to break this one again. That is what this point now is going to be what? A break of market structure. And remember what I told you guys about the definition of break of market structure. Break of market structure actually does what? It helps you to show you that the market is willing to continue towards that particular direction where the market is heading to. If it's actually heading down, it shows that the market is willing to continue going down. That is why it is breaking structure on a downward trend. Same thing applies for the bullish, which is the upward trend. You understand? Now, mark this simple difference between this bullish break of market structure and the bearish break of market structure. The bullish break of market structure happens what? On the higher high. Now the break of market structure on the downward trend happens on what? On the lower low. You understand? That's basically the difference for the two of them. So I'm going to wipe this out. So we'll continue with the other ones, right? Now we have what? The support and the resistance. Now the definition for the support and the resistance is very, very easy. It's not that hard. Now the definition for the support is a particular point where the market actually stop going up and starts going down. That's the definition for a support. A point where the market actually stop going up and continue going down. That is what a support is. And a resistance is when the market actually stop going down. The point where the market actually stop going down and continue going back up is what we call what? A resistance. Sorry, that's a mistake for me. Sorry. The support is actually the base. The resistance is the upper part of it. So sorry, that was a mistake for me. I switched that. When we are talking about the support, now let me give you an example of the support. The definition for the support is actually a point where the market actually tend to stop going down and start going back up. And the resistance is where the market actually stop going up and start going down. You understand? Like for example, now this is what a support is. Like for instance, a market is coming from an upward direction like this. Now the market gets to the particular point, now goes back up. The market comes back to that particular zone again, still continue going back up, still comes back to that zone again, and maybe finally continue going up like this. You understand? Now this point here, it is called what? A support level, because price refused to break past that particular zone. So it is called what? A support level. It's actually supporting the market from that place. Like the investors within that particular region don't want the price to actually break that point, so they are pushing the price back up. So that particular region where the market refused to break and go down is called what? A support level. You understand? It's called a support level. Now the resistance level is where the market is actually maybe from a downward trend. The market is going up like this, get to a particular point, price refuse to break there, come down, price get to that place again, refuse to break structure, come again, go again, still refuse to break structure and come down like this. Now this particular level here is what we refer to as what? As a resistance level. A resistance level is a place where price tend to what? Stop going up and actually goes down. You understand? It helps you to identify that that particular zone is actually a valid zone and price don't want to break that zone. So what you are going to be looking for is sells from that particular zones. You understand? That is what a resistance and a support level is. I don't know if I've actually explained it well for you, but if I don't explain it maybe the way you like, that is why we have YouTube. So you can go to YouTube and do what? And learn more about it, because I am not that good in everything. Nobody is actually perfect with teaching. So maybe the way somebody else might actually explain it for you might be a bit easier for you than I have actually taught you. You understand? So that's what I have to give you from my own knowledge. You understand? So that is it. So we are done with that. The key concepts of market structure. That is basically what the key concept of market structure is all about. And I know that you guys will actually understand this from the way I've explained it, because I'm using light terms to actually explain this for you guys so you can understand very, very well. Now let's head down to the next part of it, which is what? The next part of what? The properties of our SMC. The next one, no, we explain everything that we have been explaining is under what? Market structure. You understand? Now the next one we are actually explaining now is what is called liquidity. Yeah, it's liquidity. You understand? Now we have what? We have liquidity. Now the definition for liquidity is very, very simple as well. Liquidity refers to how easily and quickly a currency pair can be bought or sold without causing a big change in its price. You understand? That is the definition for it. So if you want to actually like, there are numerous definitions, right? There are numerous definitions of what a liquidity in the market is. You understand? Some people actually, they know the use of liquidity, they know what liquidity actually is, but defining liquidity might not really match what they see it as. But basically in the market, people actually refer liquidity as what? Money. You understand? Because liquidity basically is money, because that is what actually moves the market in very good volume. You understand? So that's what liquidity is about, or that is what liquidity is. You understand me? So that is that. And we have the type of liquidity. I've told you guys before, we have type of liquidity, but liquidity is breaking down in different ways by different individuals. You understand? We have different type of liquidity that people actually explain. You will see some people will actually explain to you, telling you about transactional liquidity and the rest. But the type of liquidity that I was taught from where I learned about trading, we have basically what? Three type of liquidity. Now let me write it down for you guys so you understand type of liquidity. Type of liquidity. Type of liquidity. Now other type of liquidity, we have what? We have external range liquidity. We have external range liquidity. We have what? Internal range liquidity. Yes, we have the internal range and the external range liquidity. But I don't know if I'm right, but the third one, I always put what? Inducement liquidity. I always put inducement liquidity, because this inducement liquidity is like one of the most important liquidity that we actually use, most especially when we are actually planning on entering a trade with our strategy. You understand? So these are the type of liquidity that we have. We have the external range liquidity. When we are talking about the external range liquidity, the external range liquidity, it's more like where you see what? The large market movers in action, like the large number of buyers or sellers in the market. While this internal range liquidity is like where you see little participants of investors in the market. Now this is like on a forex chart. The external range liquidity is mostly seen on what? The higher time frames. You understand? It's basically seen on the higher time frame, because if you look at the higher time frame, right? If you see maybe a higher high, or maybe a higher high on the higher, or a higher low on the higher time frame, if you go down to lower time frame, you are going to see multiple highs and multiple lows within that very small zone that you have actually seen on higher time frame. Okay, let me just give you an example. Let me cycle a particular spot for you and show you an example of what I'm talking about. Let's use here. Let me zoom it out. Let me just cycle the point. So you guys now just keep note and see. This is the point where I cycled, right? This particular spot I actually put in the box. Now how many higher highs do we have here? Now look at what we have here. We have this, let's put it like we have one high, one low, another high here, another low here. You understand? We just have what? One high, one low, another high, then another low here. Now let's go to like a lower time frame and see how many higher highs and higher lows we are going to see there. Now this one now is what? This is like a external range liquidity. Now let us go to lower time frame and see that. Let's go to like 15 minutes and let's see how many higher highs and higher lows we can actually find within that particular region. Let's just check. Now let me zoom it out so you guys will see. Now if you want to mark the high, now can you see that the first indication we make, this is it on a bigger range. Now let's delete it off. Now let us mark the higher highs and higher lows that are inside this one. Now we have one higher high, one higher low here, another higher high here, another higher low. Okay, another higher low here, another higher high here, another higher low here, another higher high, higher low, higher high here, higher low. Like there are numerous of them. You understand? Now all these ones now that are actually what the internal range liquidity. These ones now that are actually internal. You understand? They are actually internal. You understand? They are actually internal. Like inside the range of the external range liquidity, these ones are actually what? The internal range liquidity. You understand? They're the internal range liquidity. These are the structure. These are like the inner build. The inner build of what the bigger body is holding. You understand? This is the inner build of what the bigger body of the chart is actually holding. You understand? So that is it. If you don't understand properly, that's the best way I can explain it. Maybe not the best way, but for now that is the best way I can actually explain it to you guys. If you are confused, you can actually go to the YouTube and actually get more knowledge about it. So that is what the external range liquidity and the internal range liquidity is basically all about. Now let's go down to the inducement liquidity, which is the interesting one that I actually like to talk about. The inducement liquidity is basically the first pullback that actually comes to the 50% of the recent higher high and higher low created after a break of market structure. I know most of you will not get that with the English that I've actually used. Most of you will not understand what it actually means, but let me just put it in a very simple way. Inducement liquidity is the first pullback after break of market structure. Practically, this is what it means. When you have a higher high like this, a higher low like this, the market now breaks break that higher high. Now after the market break that higher high, now listen to our English. Let me stop it here. Now this is a break of market structure, right here. This is a break of market structure. Now the first pullback after break of market structure, now that pullback on the norms, that pullback is supposed to refer to as a higher low, because once the market break a higher high like this, it will create a higher low. It is a must that the market will create a higher low. Now this first higher low that actually is being created like this, this is what we refer to as inducement liquidity. That is when talking about liquidity. We are not talking about market structure. Before you go and tell me that is a higher low, yes, it is a higher low, but this higher low now is representing inducement liquidity. You understand? It represents inducement liquidity. When we are talking about liquidity in the market, you understand, it will no longer be called a higher low. When we are talking about liquidity, it is going to be called an inducement liquidity. Now an inducement liquidity, the reason why I'm explaining this inducement liquidity is because it's what we mostly use in the market. You understand? It's what we mostly use in the market. You understand? Now this inducement liquidity has a very important rule about it. First, there must be a break of market structure for you to spot out an inducement liquidity. Secondly, an inducement liquidity must come at least 50% of this high. Like when we are talking about from this high here to this low here, like if you want to draw from this high here to this low, let me just use a rectangle to do it. Let me just say from here to this point here, bring it out like this, from here to this point. Now provided this is the middle part of it. Now for instance, this is the middle part of it here, like this. You understand? Now make sure that the inducement liquidity come at least 50% here or more than 50% into this level for you to know that the inducement liquidity is actually valid. You understand me? The market has to move what? Down more than the 50% or at the 50% for you to know that it is actually valid. You understand? That is one of the properties of what that inducement liquidity carries. You understand? So that is that for the inducement liquidity. And how to incorporate all of this together, I'm going to teach you that when I'm actually done with telling you what all the properties of this SMC actually holds. We have actually explained the market structure, the liquidity, and now we're actually done with the liquidity now. So that is the last one on the liquidity. So now we'll be going to the POI, which is the point of interest. The point of interest. Now talking about the point of interest. Now there's another name you can call this point of interest for those of you that might be getting confused or something. There's another name for this point of interest. It is simply what? Entry. Point of interest simply means what? Entry. You understand me? It is called what? Entry. You understand? That is the second name for POI. You understand? It is called what? Entry. You get me? Now, let's talk about what a POI is. A POI. Now, when we are talking about a POI, it already explained itself already. Point of interest. The particular zone where you want to enter the market. Maybe you want to enter a buy or a sell in the market. That is what is called what? A point of interest. Maybe you are waiting for the market to get to this particular point before you enter the market, or maybe you place a trade. Now that particular point where you want the market to get to is what we refer to as what? Point of interest. You understand? That is the point where you want to be interested in doing something in the market. You understand? That is a simple explanation of it. Like I will always tell you, if you're not comfortable with that, you can go to the YouTube and maybe get ordinate definitions of what point of interest is. You understand? So that is that for that. And we have different type of point of interest in the financial market and what they actually are. Let's put it this way: type of POIs in the market. Let me put this slash entry so you actually know what we are talking about. Slash entry for those of you that might not understand. Now, when we are talking about this, the first one on point of interest or entry that we have what? The order block. We have what? The order blocks. That is the first one. Now we have what? The breaker block. There is this other one I want to talk about, but I don't want to use that. I don't want to use that because basically I'm I'm just teaching you the ones that are actually valid with our strategy that we easily use trading our strategy. If not, we have numerous of them. Let me just put all of them. Let me just mention all of them. You get? Let me just mention all of them. But I'm going to explain only few. We have mitigation. This one I'm just teaching you guys so that you understand it. We have the mitigation block. We have what? We have fair value gap, which is referred to as what? FVG. If you guys have seen it in the market, there's no way you will not tell me you have not seen that on maybe a professional trader's chart. FVG, which is called what? Fair value gap. You understand? That is the meaning. Fair value gap. FVG. Fair value gap. Now we also have what? Sorry. That's the fair value gap. And we also have one which is called what? The QMR. The QMR. This QMR simply means what? Quasumado or Quasimido reversal. You understand? It is called what? A Quasimido reversal. You understand? Now, these are the type of POIs that we actually have in the market. You understand? We have the order block, we have the breaker block, the mitigation block, the fair value gap, the QMR. We also have what? The trend line entry. We have a trend line entry that does not require you using an order block. Like for instance, now this trend line, okay, this trend line entry, I don't want to talk about the trend line entry, but basically I'm going to teach you guys about the trend line entry. Now look at this good chart that I have here. You can see that I actually draw a line from a particular zone to touch another zone to continue going up. Now if you see, now if you notice, now for those of you that know how I trade, you see that this particular point, this straight line that I marked, this very straight line, now this very straight line here, I'm coming, let me bring out my icon and show you this very straight line that I drew here, this very one, it is on a order block that I drew it. And all of you know me that I don't take trades just directly on the order block. I go to the 50% of the order block. That is because a proper mitigation in the market happens what? At the 50% level of a POI. You understand? That is where I enter my trades from, so that I can actually get what? Maybe swift entries like a sniper entry or so. You can try it out in your charts and see, maybe in making your analysis. For those of you that are already trading already, you can actually check it out and see 50% of every POI actually gives you what? Gives you a sniper entry. You understand? Not all the time, but 90% of the time, that is what you are going to get. You understand? Because nothing is actually 100% correct. I would have said it is 100% accurate, but sometimes even with the 50%, it might actually pass the 50% a little. But sniper entry on 50% level of POIs, it's sure. It's something that happens, let me say 97% of the time in the market. You understand? You understand? So that is it. You see that this trend line strategy now, this trend line entry now, you see, from this trend line now, the market came, tap on that same line that I drew, yeah, went up again. Now I'm expecting it to tap on this same zone here again, on that same trend line, to continue buying up. But you cannot just mark that alone. I need other confluence, I need other things to make me to be sure that yes, it is going to work out like this. I have another block within that zone where it intersect on my 50% level that I actually mark on that other block. You understand? So that is it. But we are not talking about trend line entry. So I'm just showing you an example what a trend line entry is. So that is that for that. Now let's focus on what is important to us. That is important, but that is my own thing that I do. So now let me teach you what is easy for you and basically what you are going to use in the market, which is very, very important to you. Now, the first on the line we have is what? We have our order block. Now, what are order block? Now, before I say this, let me correct you guys. My chart is basically, I changed the color of my chart. The color of my chart is what? Is white and black. Now, note this, take this into consideration. My white candles are what? Now, a proper financial market chart is what? It is colored in green and red, right? Now, the green candles on your chart are actually my white here. Now, your red candles are actually my black here. Some persons will ask you that why are you using this kind of colors on your chart? I'm using it because those green and red color candle gives me this fright that I don't really like. I must confess to you, I don't like that color. Whenever I see that color, maybe I'm in loss like this and I'm seeing that color alone, it makes me feel like I'm in very serious trouble. So that is why I don't use them. At least this one is preferable for me. It's just calm and cool. You can actually change yours too, as long as you can understand what you're actually doing. So that is it. So now when we are talking about the order block, the order block, we have two type of order block. We have order block on the bullish and we have order block on the bearish, right? We have order block on the bullish and we also have order block on what? The bearish. So don't get confused, right? Don't get confused about this order block stuff. We have order block on the bullish and we also have order block on what? The bearish. Now let's go with the order block on the bullish. Now pay attention because I will not be spending time. I've already spent time, a lot of time creating this. I think more than 1 hour for now. I don't know, maybe it's even up to 1 hour, but let's dive into the order block. And first of all, we are going with what? The bullish order block. We are going with what? The bullish order block. Now, the bullish order block, it is identified on what? On the last red candle created before the market breaks structure on the higher high. That is what we refer to as what? Our order block. Now, this is what I mean. If you have what? A higher high, a higher low, a break of market structure here, which is here. I'm repeating this break of market structure so you understand. This is a break of market structure. Now this is what you guys are supposed to understand very, very well. When the market is going up like this, it is more of what? Green candles. And when the market is dropping like this, it is more of what? Red candle. Now the last red candle here, the last red candle here before this break of market structure occur is what we refer to as what? Our order block. And we use this rectangle to mark it. You put it on the head of the block like this, mark it like this, the full length of the block, the last block that is there. That is what an order block is. You understand? That block is referred to as what? An order block. You understand? Now, for this order block to be very, very valid and known to be proper order block, this break of market structure has to happen first. You understand? For you to know that this order block is valid. Now, let's go to the chart so that I will show you what another block is. And let me show you why another block, it is another block. Let me find a very cool place where I can teach you what another block is and how effective another block actually works. I'm coming. I just want to show you a slight, like a very, very clean place. I've seen numerous of them, but I just want to find one that is actually very, very, very cool so I can show you. If not, I've seen more than 50 of them. I will say 50. 50 is more now. I've seen more than thousands of them here. But I'm looking for the one that will be very, very easy for me to explain to you guys so you understand. I'm looking for one that is going to look very, 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 very nice. Okay, now let us look at from this zone here. Let's look out for within this zone here. Now within this zone here now that I want you guys to focus on this zone here. Now if you focus on this zone now, you will discover that we have this. We have what? A higher high. We have what? A higher low here. We have what? Another higher high here. You understand? Now we have a higher high. Now what? We have what? A higher high, a higher low, a higher high. Now what you are supposed to know is that this higher high that was created here, this market has already broken it. So this is what? A break of market structure. This is it. A break of market structure, right? That is a break of market structure. You get me? Now, if you are going to, after this break of market structure now, what I want you to understand is the last, now, this is what I was telling you about. When the market is going up, you can see that here, as the market is going up like this, can you see that the market is creating more of these white candles? And these white candles now represent what? It represents the green candle on the proper chart. You understand? I'm coming. Let me not use this. This range is too big for me to explain it for you. The range is very, very big. Let me find a place where it's very, 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 very small for me to explain it to you so you understand. Let me find a range that is actually very, very small so I can explain it to you. I don't want to use a very, very wide range. Let me go to like 30 minutes time frame. Go to like 30 minutes time frame. Go to like 30 minutes time frame. I'm coming. Let me look for it on the 30 minutes time frame here and show you guys. Oh god, I don't like all these things. I'm looking for like a very sweet one that I'm going to explain to you, because the clearer it is, the better you understand it very well. Now let's look at it around here. Now let's look at within this zone. Sorry, let's look at within this zone here. Now, if you look at this, now you see that we have what? We have a movement from here that created what? A higher high here, created a higher low, created another higher high here, another higher low here, right? Created another higher high. I beg, leave that dog. I beg, make you no make noise. I do something. I beg. Created another higher high here, another higher high here, and that's it. So if you look at this, very well, you are going to see that we have what? A lower low here. We have a higher high. We have a higher low, another higher high, and we'll still have another higher low here, and we'll have another higher high at the top there. Now, what you are going to discover is that we have a break of market structure around this zone. If you guys will pay attention very well, we have a break of market structure around this zone, which is here, exactly here. You understand? There was another one behind here as well, right? There was another one here. You understand? Now, if you look at where this break of market structure is, I'm coming, let me remove this icon so you see it very well. If you look at where this break of market structure is here, look at where this break of market structure is around this place. You see that the last bearish candle that was created was this one here, this small red and this small black candle. On a proper chart, this is supposed to be a what? This is supposed to be a what? A red candle here. Look at it. This was the last candle. You understand? That was created. You can see that the market came into that candle and what? Continue going up. You understand? The market came to that particular zone and continue going up. But this particular pair I'm using to teach you now is actually good. And good is actually very, very random when it comes to stuffs like this. You understand? I'm coming. Let me check if I can use another pair to explain this thing to you, because it takes those that are actually have good quality in trading to actually identify most things on good, because it's a very deadly pair that can ruin your life as well. So, and let me use another pair to explain it to you guys. Hey, this trade almost hit TPO. Nice one. Nice one. Now, maybe I'm going to use this GG. GG has GPGPY has like a very good structure. When you're talking about trading, it has a very good structure that I can use in explaining this to you. Now, what did they pay me be this? See, guys, I'm just going to find a way to get a very good structure for me to explain this thing to you. If not, for me to get like a very good form of how I'm going to explain this to you, I'm not seeing it on the chat here. I don't know if that's because of my fault. I don't know, but I'm not seeing it on the chat here the way I want it. The way I'm coming, there's a way I'm going to teach you guys about this thing. Sorry, that you actually understand. I've been wasting my time since. Let me just use the best way that I can actually use in explaining this thing to you guys. I've been wasting my time since. Now, for instance, let me use this particular icon. I'm coming. Now, let me use this, my rectangle, to form the chart for you. For instance, you have something like this. This is a candlestick. Come on, I did not draw this candlestick from a very right part. Come here, let me explain it to you guys. Sorry. Now, provided we have this, let me draw the structure first, then I'll explain. We have this, a candlestick. We have another candlestick here. I will still have another candlestick like this. Yes. Now, and one thing you need to understand is this is like the market's going up, right? That is the first one. Now you still have another candles coming down like this, and you have another ones coming down like this as well, right? Now, oh my god, I've made a mistake here, but let me just correct it. Let me correct it instant. Let me correct it. That is why lecturing is very, very stressful. Making videos like this is very, very stressing. I'm coming. I have to change the color of these candles so you actually identify them as I'm using them to teach you. Let me change the color of it. When the market is going up, it is said to have what? Green candles, right? Let me enhance the color of the green candles. Yes. Like this, the market is going up. Yeah. Like this. Now, let the market, let me, I have to change the color of the candle again. Can you imagine? Stress won't kill me. Oh, stress won't kill me like this. Now I have to change it to what? To red. Because when the market is actually going up, it creates series of what? Red candles. Now I'll have to create red candles, green candles again. Now pay attention to the structure that I'm actually teaching you guys. Just pay attention to the structure so you understand what I'm talking about. With the way I'm placing this candle, you can see that I'm actually using it to form what? To form a structure. How are you? I'm using it to form a structure. Now, if by me looking, you can actually see that I did what? I successfully formed what? A higher high, a higher low, and another higher high like this. You understand? Now, this is a break of market structure here. You understand? This is the break of market structure. Now, once you have this break of market structure, now what another block is? Another block is this last candle here. This last red candle here. That is what another block is. When you have the market what? Go up like this, create a higher high, come back, create a higher low, go up like this, create what? A higher high. Now, this is a break of market structure. Once the market breaks this structure, the last red candle within this zone here is what we refer to as what? Our order block. That is what an order block is. You understand? That is what an order block is. You understand? For those of you that understand me very well, that is what an order block is. Now, most of you will be asking me that in most cases, the order block, you will see the last red candle will be here, and you still see like maybe like this candle now, like this. You still see another red candle will form as the market is going up like this. You understand? Like maybe another red candle will form along the line as the market is still going up, but still under within the break of market structure. Now, what you are going to do in positions like this, don't worry, I'm not going to teach you about this particular one. Just take this as what I'm teaching you. Just take this to be what I'm teaching you. Okay? The last red candle here is what we call what? Our order block. You understand? This is it. The last red candle after break of market structure is what we refer to as what? The order block. You understand me? So that is that for what? A bullish order block. Now it's time for me to do what? Time for me to explain the one for the bearish. Oh god, another stress again. Okay, let me delete this one, delete this one, delete this one, delete this one. Now let me just draw from here. Let me just draw from here, which is what? The red candles. Let me change it to red. That's a red candle. A red candle again. Maybe another red candle here. Mimi, how are you?
Fine.
Now you have this. Now the structure that I've actually built here is very easy, but since it's candlestick, you will not understand it. That is why it's always good to use candlestick and lines when teaching somebody. Now this is what? A lower low, a lower high, a lower low, right? Now this is a break of market structure here. Now remember what I told you guys. Break of market structure on a downward trend happens what? On the lower low. On a bearish trend, it happens on what? On the higher high. So now this is a break of structure. That is if the market is going down. Now after this break of market structure, the last green candle after break of market structure here is what we refer to as what? Our order block. You understand? You guys remember that on the bullish trend, the last red candle, on the bullish trend, the last red candle is what? Our order block. Now on the bearish trend, the last green candle after the market break structure here is what we refer to as what? Our order block. You understand? That is what an order block is. I hope you guys understand me. So that is the difference between the bullish order block and the bearish order block and where they are actually spotted. You understand? So that is that for the both of them. Now we are headed down to what? To breaker block. I'll have to delete this thing again and explain it to you guys. I have to break this down again and explain it to you guys. Now we are headed to what? To breaker block. And mind you guys, I am going to teach you guys about order block and breaker block mostly. That's because that's basically the two that we mostly use. But I'm going to, in another class, I'm going to teach you guys about this mitigation block, fair value gap, and QMR. Those ones are actually additional. But basically for our strategy, the ones I want you to actually use and know is order block and order block and breaker block. But I'm still going to explain the rest of them to you. Time no day, I'm already sweating already, safe. Now when we talk about the breaker block, let me first show you like a graphical example of what a breaker block is. For instance, we have, and for breaker blocks also we have the bullish and the bearish. Now I'm explaining the bullish. Now when you have a structure of a market like this, the market creates what? A higher high, now a higher low, now another, now a break of market structure here. The market has actually broken structure because it break past the higher high here, right? Now where are we supposed to spot our order block? The last red candle here, right? Because that's our bullish order block. Now what we'll be expecting when we have another block in the market, what we always expect is the market to come from here, tap into this order block and continue going up, right? Basically that is what we always expect in the market. But whenever you see a market, now instead of the market tapping the order block and continue going up, you see the market will do something like this. The market will break that order block like this. You understand? The market is going to violate that order block. Now once the market violates this order block, it is said to be a what? A breaker block. That is what it is said to be. This order block now, the name is going to change from an order block to what? A breaker block, because the market has already violated it. You understand? If this thing is a cement block, if this thing is a cement block, and maybe you use like a cutlass to stroke it, definitely it's going to break into two. You understand? Meaning that the block has already been broken. That is just like a layman explanation I'm actually giving you. the market has actually violated this order block, and the market violating this order block, it does not mean that the block is not useful again, but the name of the block is going to change from an order block towards a breaker block, because what the market has violated already. And once the market violates this order block, what do we expect? We expect the market to do what? To go back, tap into that breaker block and continue going down. You understand? When an order block turns a breaker block, it does not mean that block is useless. The block is still very, very useful. That is why it is what? A breaker block. You understand? It's more like, okay, let me tell you. Let me like give you like a very funny example. Like, you see when somebody peel like cassava, like you peel the back of a cassava, you see that to other persons, since you already peeled the back, the back is actually like useless, or maybe you have actually gotten what you want, and the peel of it is not useful anymore. But you can see somebody else can actually pick that peel of that cassava that you have actually peeled out and give it to like maybe an animal, like maybe pig or something, to consume. That's to show you that even the peel of that cassava is actually useful for something else. So that is what a breaker block actually does here in the market. Whenever the order block is violated, and it's actually what a breaker block, the breaker block it is still used to what? To continue the market movement towards a downward direction. You understand? So that is what the breaker block is. You understand? A violated order block is what? A breaker block. That is the definition of a breaker block. Now, this is the one for what? This is the one for the bullish. You understand? It is the one for the bullish. Now, let's head on to the one for the bearish. Let me explain that one to you too. It is just the opposite of anything that you actually know on the bullish. The opposite of it is the one for the bearish. Now, we have a downward trend, a lower low, a lower high, a lower low, a lower high, a lower low. Let me just use 3 lines so you won't, it will be easy. I have a lower low, a lower high, and a lower low. Now this is a break of market structure here. Alright, this is a break of market structure. Now the last green candle here is supposed to be our what? Our order block, right? But now, for instance, now instead of what we'll be expecting is for the market to do what? Tap here and continue going down, right? But the market didn't do that. You will now see the market will do something like this. The market will now violate that order block and continue going up. Now this bearish order block has been violated. You understand? Now this bearish order block now has actually turned what? Into a breaker block. You understand? And the next thing you see the price will do, you see the price will actually come back here and what? Continue going up. You understand? That is basically how the breaker block works. You understand? So that is that for the breaker block. At least I've explained the two type of breaker block. So in our next class, I'm going to be talking about, maybe I'm going to give you, no, I don't have to even do that. I don't even have to do that. I'm going to simply explain what a fair value gap is. Mitigation block and QMR, I will explain it in some other classes. But this fair value gap, I'm going to explain to you guys what a fair value gap is, because this fair value gap actually, there is something I want to teach you guys about fair value gap and order block being used together. So I'm going to teach you guys what fair value gap is. Fair value gap is the space between 3 candles. For instance, you have a candle like this. You have a candle like this. You have another candle like this. And you have another candle like this. Candlesticks are not just plain like this. So candlestick always have small wick on them like this. They always have small body wick on them like this. They are not just plain. There are some that can actually form and be plain like that, but they are always having what? Little wicks on them like this. They are always having wicks on them. Don't mind me if the lines are not straight. It's just explanation I'm giving to you guys. They have to be like this. You understand? Now, what you are going to do is to use this rectangle. this rectangle, this box. Place the box on the last wick of this upper candle here. Tap it like this. Bring it down to this point. I'm coming. Let me change the color of this thing, maybe to like Now, this is what I want you guys to understand. From here, from the wick of this candle here, yes, from the wick of that candle to the top of this other candle, the third candle below here, the space, there's the space in between them like this. The space in between them like this is what is referred to as what? A fair value gap. You understand? This is what a fair value gap is. You understand? The space in between the lower part of that upper candle and this down one, the upper part of this this third candle below here, the space in between the both of them is what we refer to as a fair value gap. But when you see the market do something like this, hey, whoa, I don't go delete, I'm not supposed to delete. Come on, let me draw it back. Change the color. Now, for instance, now you see this one, like this wick now. Hey. Now, when you see a wick like this, maybe this one has a long wick like this, yeah. And this one as well has what? A long wick like this. Now you can see that there is no space between the both of them. You can see that there is no space, because if you draw from here now, if you want to draw from here now, you see like this, there is no space between the both of them. Why? Because the wick of this candle has already gone up already. This one too has already come down like this, so there is no space between the both of them. But when you have the market do something like this, maybe a small one like this, and maybe this one, okay, don't mind me, the thing is not straight. Now you can see that from this one down to this one here, there is a space, right? Now that is what we refer to as what? A fair value gap. You understand me? That is what a fair value gap is. And it is also used to enter a trade as well. You understand? It is also used to enter a trade as well. So that is that for that, guys. So I think we are going to rest here. We have actually hold this class for more than an hour explaining all of this. Jesus Christ, I don't go delete my entry for trade. So that is that. So the way I've actually explained this strategy back for you guys, these are the properties of the strategy that I've actually explained for you. It is not this thing. It's not how the strategy works. So I'm going to make another video today. I'm using this video now to refresh your brains about what our strategy is and the properties of our strategy. So the next video I'm going to make is the video where I'm going to incorporate everything, where I'm going to be joining the break of market structure and the inducement liquidity, the order block or the breaker block to take a trade. I am going to use that to explain to you guys how to take trades with all of them. Doctor. So that is what I'm going to do. Okay. So this will be the end of this particular section for now. So bye guys. You wait for the next video.